Beyond this, how are OMCs stacked, and what's your view here?
So structurally, we are not so positive on OMCs. One, on valuation ground, they're trading at 20-30% above historical valuation on price to book, 1.3, 1.4. And our key structural concern there is the huge capex spree which they are in terms of setting up refining capacity, where there's a lot of terminal value concerns, and also petchem, where margins are quite at tough levels. And most of these capex tend to see significant time and cost overrun, and hence tends to be value destructive. So probably buying OMCs when they're trading sub one-time book is where we are comfortable with. Buying at 20-30% above price to book, I think the risk reward is against you.
No, absolutely, and I think that's the we got to buy it cheap, really cheap. That's the basic message, right? These kind of names.
Yeah, completely.
Yeah. And which is not the case right now.
Which is not the case right now.
Okay, and of course risks are also slightly higher. With all this which is happening, do you have coverage on some of the gas stocks? Dayanand, any thoughts here?
Yeah, so we have a positive view on GAIL, which would be a beneficiary of high oil price. We also like Gujarat Gas, but it's more on the assumption that spot LNG prices moderate to more normalized levels in next 1 or 2 years, with a lot of LNG supply capacity coming in. CGDs, apart from Gujarat Gas, IGL, MGL, we have a negative view on structural concerns given the APM allocation cut and EV related impact on volumes. Yeah, so Petronet also we are not very positive, primarily because of their capital misallocation concerns on petchem side.
Yeah. Okay, Dayanand, thank you very much for joining us. Really useful conversation this morning. We've got the market open coming up. We'll look at indices and we'll go down to stocks. It's a sharp cut, 1.5%. So 24,552 is where we're at. So you're basically we opened at the lower bound of the support zone, which is the 40-day exponential moving average. So 24,500 is that number. I think we hit it. And we're around it now. So 24,570 or so on the Nifty. So about 1.25% lower. The Bank Nifty is down 1%, 55,495. The mid-cap index is down about 1.6. And I think the small-cap index, of course, also down similarly. The thing is, it's a weekend. The news flow indicates so far, at least from Israel, that this is going to go on for a few days. So it's not like a short-lived operation. They're saying, well, it could go on for several days till their objectives are achieved. So there is the weekend risk, which also suddenly starts to appear in a meaningful way. But we'll see. You're at the lower, the first support zone. Actually, the second support level, which we mentioned in the morning, which is the 40-day exponential. Let's see if you're able to hold on to it with this 1.4, 1.5% kind of cut. Heat map on the Nifty, I think, should be predominantly red. Only one name, upstream, ONGC is high, everything else is down in the red. Rima.
Indeed, so ONGC is up 2.5%, but that's the only Nifty stock which is currently in the green. But you've also got green in the form of Oil India. So talking about the only beneficiaries of the spike in crude prices, ONGC and Oil India. But on the way down, oil marketing companies, 4% gone, BPCL, HPCL, IOC. Aviation names, look at Interglobe Aviation and SpiceJet, both of them down nearly 4 to 5%. And Sona BLW Precision, Sona Comstar, where the promoter, Sanjay Kapoor, unfortunately, in tragic news, has died of a heart attack. The stock has taken a bit of a knock. Outside of that, in the large cap action, you've got L&T, weakened trade. That, in fact, is the top Nifty loser. Adani Group stocks are correcting. Adani Ports, Adani Enterprises have a cut of about 2.5%. Some IT names are on the back foot. So Infosys, Tech Mahindra, subdued. Shriram Finance also down more than 2%. Throw in a couple of auto names where you're seeing red on the screen, like M&M and Bajaj Auto. Now you've got Apollo Hospitals, which is nudged back into the green. But again, the gain there is pretty insignificant. 0.1% on Apollo Hospitals, but predominantly red. The good thing is the Nifty is holding on to 24,500. In fact, as we speak, Nigel, almost at the 24,600 mark. And the mid-cap fall is about 700 points, so in line with the large cap.
Well, that's right, Rima. As of now, you have only 140 stocks that are advancing on the NSE. By the time we wind up today, you'll want to see far more number of stocks that are advancing, though the global picture is still very, very skittish. A few stocks that catch your attention. IRDA, that's under pressure. I think the QIP allotment has come about, so that explains why that stock, in fact, is lower in trade. So a sharp downtick is what we're seeing out there. But otherwise, some oil-related, exploration-related names are doing well. Ceylon Exploration is up close to 2.5%. You mentioned Oil India, you mentioned ONGC as well. That stock as well is doing quite well. So those are a few gainers out there. Another stock that's moving up is Innova Captab. I think, we don't talk about that stock very often, but that stock, in fact, is higher in today's trading session as well. The ones that are getting pounded are the OMCs. You have the paint-related names as well as aviation stocks. All of them are losing out in trade as we speak. So a subdued start. Canara Bank is another one that's down close to around 5%. So keep an eye out on that name. A soft start on expected lines. Hopefully, by the end of today, will be higher than what we saw at the start.
So already, I think about 100-point lift coming through on the Nifty from the opening levels, which was around the 24,500 kind of mark. Pretty big surge in terms of oil is what you have. That's Prime Minister Modi visuals coming in. And I think, we'll have more on this as we kind of sort of go along. But those were visuals of Prime Minister Narendra Modi coming through. This is, of course, he's at the civil hospital in Ahmedabad. Tragic incident yesterday, and just a complete tragedy in that sense. Let's just welcome in Manishi Chaudhary, who's with us with just what he's making of things here. Manishi, good morning. Great to have you with us on the program. I think the big talking point, of course, is the big surge in oil. No one knows how this kind of goes. If history is any suggestion, it's short-lived. The spikes are short-lived, even if they are sharp. So I guess you just got to go with that. If the Strait of Hormuz, as we were discussing, is closed, then no one knows what will happen. But what's your sense? How do you assess risk-reward from here for markets broadly?
What's happening today, the reason for that is obvious. I mean, we've pretty much all the Asian or emerging markets down anywhere between 0.7 to 1.2%. And it's a direct fallout of the increasing geopolitical tensions in the Middle East and the consequent the spike in oil prices. Now, one doesn't know how long this tension would continue. One can only hope that the military tensions die down or are resolved, pretty soon. But, honestly, these things are completely unpredictable. In the near term, we obviously will have to tighten our belts, brace for more volatility, but that's the only thing I guess one can say from a fundamental perspective. If you look at the longer term, once these military tensions are behind us, then emerging markets and in particular Asia have a lot going for them. There are quite a few tailwinds that have aligned together. We have seen the US dollar weakening, and that's actually likely to continue for some more time. And as a consequence, we are seeing the Asian central banks getting a much higher degree of confidence in injecting monetary stimuli through rate cuts and reserve ratio cuts. The most recent example is the RBI, which actually front-loaded these actions. So, we have quite a few things going in favor of Asia. The only thing that I think still needs to fall in place is an earnings estimate recovery, which was beginning to happen for a brief while in late 24 and early 25. But the earnings estimates are coming down again, except for, I think, a few markets like Korea and Taiwan. We have seen earnings estimates decline, and that's true of India as well. So I think we need that earnings picture to stabilize. Hopefully that'll happen once the impact of these monetary stimuli hit consumption and investments, possibly in the second half or maybe in the last quarter of this calendar year. But till then, we will have to be prepared for a range-bound movement of equities in this region.
So markets are range-bound. Manishi, hi, Rima here. So how are you positioning yourself now in the Indian market? Take us through your portfolio and your big bets.
Right. So we have an Asia ex-Japan model portfolio, which we recommend to clients. And we actually have an overweight stance on India on that. Compared to a benchmark weight of close to 20% for India and MSCI Asia ex-Japan, we have somewhere around 23 to 24%. The largest weights in that portfolio are the private banks. I have been harping on the private banks for quite some time now, and that stance hasn't changed. I mean, if we're going to have growth in investments and consumption, that'll have to be financed largely by the private banks, which are gaining in terms of market share. Second, we do have consumer discretionaries, and that's a combination of both automobiles, particularly four-wheelers, and some of the higher end premium consumption, like jewelry. I would also add some of the tourism related names to that bucket. Third, we have some exposure to the IT services that's more tactical than strategic. We think that the valuations are now in favor of investors. And if we do have, the US corporate performance turning better, particularly for banks and the other for service sector, that would have a positive tailwind for Indian IT service companies. Yeah, so these are some of the the important exposures that we have. We also have some exposure to telecom, petrochemicals, the conglomerates that you can think of. I'm not going into any names, but it should be obvious. So that is really our India exposure in our portfolio.
Hi, Manishi. Good morning. Good to see you again. It's a bit of a subdued start to trade, both for the markets globally as well as emotionally. But, at times like this, when you have geopolitical tensions that rev up yet again, it provides opportunities at times. And one sector of the market that's been getting a lot of attention is the defense space. Some of those valuations have gone, out of whack. While there's a counter argument that there's going to be increased focus, increased spending on the defense side of things. So these companies ultimately, the earnings will catch up to these prices. What's your view on it?
So defense sector is something we like. In fact, in response to Rima's question earlier, there's one sector that I did not mention is industrials, where we do have significant exposure in our portfolio, and that includes, some of the dedicated defense names. The problem in the sector is valuations, because a lot of significant growth expectations going forward have already been factored into the prices. So, even if those lofty expectations are realized, and I'm not saying that they won't be, but even if they are realized, the valuations may not really move much higher. In fact, we may have some kind of a plateauing of the valuations and share prices for a while. I would not expect these stocks to decline significantly on an absolute basis. But what you may see is, what's called a time correction in this sector. So investors would have to be a bit careful in terms of valuations when adjusted for future earnings growth when picking stocks in this sector.
You said India's weightage is 23% versus a benchmark weight of 20% in your portfolio right now. What's the most in terms of, India's, what's the maximum that you're willing to go? Is there more headroom for you to up your exposure to India?
Right. Now, that's an interesting question. I think that willingness would come once the headline valuations, particularly the relative valuations of India, narrow down a bit. This was actually the situation sometime in March. Indian valuations peaked out in September, then for about 6 months, they drifted downwards, while North Asian valuations, the North Asian markets outperformed India. But since then, we have had another spike in Indian markets, Indian valuations. So that relative valuation gap, which had narrowed down, has opened up again. Now, of course, I think over the last 1 week or so, we are seeing another round of pullback in India. And simultaneously, there are some North Asian markets like Korea, which have spiked strongly. So I'm hopeful that that relative valuation gap may narrow down again, possibly in the second half of this year. But, India's valuation premium to Asia, which is somewhere between 35 to 40%. That's the long-term average. It would really needs to come down there. Currently, it's somewhere around 50 to 52%.
Got that. 50 to 52% is India's valuation premium. So you laid out some sectors that you like. Large private banks, you've always been bullish on that. Some consumer discretionary, which includes jewelry. Some, I think, tourism names, industrials, which has defensive, and a tactical bet on IT. At this juncture, if you have to put incremental money to work, which sector would you buy right now?
One easy way of responding to that is, buy more of, what we already have, or buy more stocks in the same sectors where we are exposed. But there's one sector, if I were to look at the sectors that we don't have exposure to, which we are avoiding at this point of time, the most prominent one is consumer staples, where we clearly think that the valuations are not in favor of investors when one looks at the future earnings growth. We also don't have metals and mining, but that is something one has to look at carefully, because I think some of the some of the metals and mining exposures, particularly say in copper, could actually do better if we do have kind of a broad-based improvement in infrastructure investments. Copper is one of the biggest barometers of that. But broadly, I think our sectoral allocations would remain unchanged, even if we were to sort of allocate more to the Indian pie.
Point taken, Manishi. Thank you very much for joining us. It's a pleasure having you here on CNBC-TV18. Good sort of contextual regional commentary with, of course, India at the center of it. 24,625 is where the Nifty is at. So we're off about 120 points off the lows of the day, lows of the morning, really. 10:1 is the declines to advances ratio, and maybe we'll look at this in a bit from now. Look at, there are, of course, with regards to airlines, etc., there's, of course, a tragic accident yesterday. And then this morning, there is also this 12% surge in oil prices, and we're going to talk about both of them. But let's talk about the tragedy first. And our colleague Madiha went down to Ahmedabad. She's in Ahmedabad right now at the crash site with, of course, what's happening, what's the latest update, and what she's picking up. She's, of course, been speaking with many aviation experts to try and figure out what really happened. But tell us, Madiha, morning.
Hi, Prashant. We are currently at the crash site, just meters away from the crash site, and the area is now barricaded. The journalists or other visitors are not allowed, because we also had the Prime Minister moments ago visiting the crash site, talking to officials, talking to investigating teams. He's also now headed to the hospital where the injured are being taken, and there are victims' families there, so he's going to speak to them. What you see behind me are the 4 buildings, and the last building, the 4th building, is where the plane crash landed. It was a Boeing 787 Dreamliner that was operating flight AI-171, Ahmedabad to London. The flight had crashed in seconds after it took off from the runway. There were 242 passengers on board, including 2 pilots and 10 cabin crew, and only 1 passenger miraculously survived. Remember, the flight was carrying 125,000 liters of fuel because it had prepared a journey to London, so that the tank was full. And when it crashed, just seconds after the takeoff, it exploded into a huge flame, resulting into almost no survivors, and only 1 survivor, 1 passenger, miraculously survived, and he's believed to have jumped off the emergency gate that was next to his seat. So 242 passengers and 1 survived. That included 2 pilots and 10 cabin crew. So a very, very tragic moment for India. It is also a big global tragedy. It's a 787 Dreamliner, and the first fatal crash for a 787 Dreamliner. The Boeing planes have had history of air accidents in the past, but they were all 777s, Boeing 737 NG, 737 MAX, and 747. But a 787 Dreamliner has never been involved in a crash or a fatal crash. Never, and this is the first of its kind that it has been involved in such a crash. Also, a major tragedy since 2023. In 2023, we had the Yeti Airlines crash in Nepal. It was a turboprop plane that had led to the death of over 60 people. In 2024, we had the Azerbaijan Airlines plane crash and the Jeju Airlines plane crash at the Muan airport. In 2025, Air India plane crash in Ahmedabad becomes the major tragedy, not just in India, but also globally. We continue to track the developments. We are being told that the casualties, apart from the passengers, the number of deaths are high because the plane crash landed at the hostel of the medical college, and there were students, there were doctors who were inside the campus. There are deaths there, there are injuries there, but we are still to confirm how many deaths, how many casualties are seen at the hospital.
And we'll keep coming back to you, for those updates as you get updates from, the hospital and, what is the latest situation out there. Thank you very much, Madhya, for that update at this point in time. I think we got some visuals coming through. Prime Minister Modi actually now coming out of the hospital, the civil hospital in Ahmedabad. There you go. We'll just, I think, Prime Minister arriving this morning to the hospital, meeting survivors and the injured. Of course, from the flight itself, is being widely reported. There's only one survivor, but those are visuals essentially which are coming in. We also spoke with N. Chandrasekaran, chairman of Tata Sons and of course Air India as well. And my colleague Shireen spoke with him. N. Chandra calling this the worst professional sort of day of his career. Listen to that soundbite.
It is a totally devastating tragedy, and we are all totally shocked and deeply affected, and our immediate focus is to help the people, the families of people who have experienced this tragedy. We are working through that at this point in time. We are trying to set up all the support systems, the emergency helpline number, and on-the-ground support. A lot of people from Air India have flown from Delhi to be here on the ground. So we're creating all those infrastructure. While we are trying to do all of this, we are also working with the authorities to see the investigation and the root cause, etc. I have spoken to the CEO of Boeing, and I've also asked him to send the best expert to work with us in this whole process. To help the families, we just announced that we will provide 1 crore for each family of the person who lost their life. And also we will be providing all the medical related expenses for all the people who are injured. And we would also try to help to rebuild that infrastructure in the hostel where the crash actually happened. It is the worst day of my professional career, I can tell you that.
Well, that is N. Chandra, Chairman of Tata Sons and Air India. His comments there reflecting, of course, the general mood out there, which, of course, is pretty down and out after the tragedy yesterday. Kinjal Shah is with us, co-group head and senior vice president at ICRA. We also have Mark Martin, founder and CEO at Martin Consulting. Gentlemen, good morning. Great to have both of you here. Thank you very much. Mark, let me come to you. Just on, this is an aircraft, of course. And by the way, as I understand it, Air India already has, I think, about 20 or 25 pending orders for exactly this model of the aircraft. Is there a need is there while we wait for what exactly happened, and I think it'll come out during the course of the investigation, will this lead to a bit of a reconsideration for this specific model across the board?
No, I mean, thanks for having me. I've come on CNBC in much better pleasant times, and it's unfortunate that we need to respond on possibly the worst ever air disaster in 30 years in aviation, at least modern history. The 787 worked great with Air India from 2011 till 2025 till this day. The 787, now granted, has had maintenance issues, has reliability issues, has had maintenance quality issues, but never has the aircraft broken up or never has the aircraft structurally failed. And what we've seen here clearly is that the aircraft took off. He was at 600 feet. He was getting into his climb phase. He needed engine thrust, and the engines let him down. So now, what would have improved the survivability of this? Well, guess what? Those who have traveled to most parts of the world know this very well. That airports are deliberately kept at least 60 kilometers away from city and urbanization. So when you take off, you have just fields and fields and fields. So even if you were to bring the aircraft down, we're just going to bring it down on a soft field. But with urbanization, we've actually created these huge mega office blocks, buildings, offices, residential plots, apartments right next to the airport. So there's no chance in hell that any aircraft can even recover from an engine flame out or an engine failure. Fundamentally, the 787 is a pretty good aircraft. It flies in over 40 airlines across the world. India was the launch customer for the 787-8. It was an iconic aircraft. It still is. It's one of the most advanced aircraft out there with fiber optics and a servo on board. Air India mastered operating that aircraft. The pilot had 10,000 flying hours. One of the finest aircraft in terms of cabin quality. And I'm gonna raise one question here, and let's not dodge this bullet. This incident happened after 2021 when Air India was transferred over to Tata's and Singapore Airlines. I mean, we all criticized Air India when it was under government ownership that Sarkari airline hai, Sarkar hai. But guess what? It's a private airline for 4 years. And Air India, since 4 years, continues to have not just this, but subtle, sublime violations from pilot, crew, training, maintenance. The DGCA has fined Air India the highest. Till today, I mean, you know the reviews as much as I do. The aircraft quality is lousy. The maintenance quality is bad. I mean, this is under a private Air India. So let's come down to facts over here and be factual. This crash has happened to an Air India that's a private Air India, not a government Air India. And enough is enough. I think clearly, and this investigation, before I finish, just give me one more minute. This investigation no longer is going to be, smoke and mirrors with the government and AIB and DGCA. This is a global affair. The world's first 787 crash. So we have the NTSB, we got EASA, we have Transport Canada. Every investigating agency has sent over a representative and a delegation to find out what happened. And it's high time we have accountability. The government of India, Mr. Modi, the ministry, Mr. Naidu, they need to start sharpening their knives and crack the whip, because enough is enough. It's a private airline. We need to hold Air India accountable. We understand we're all mourning. It's a tragic situation, extremely sad. My heart goes out to everybody, including the airline right now at this moment of grief. But we need to get to the bottom of this, because we cannot have this anymore. And the worst part is, guess what? Air India has the word India in it. And I don't like to see my country and my name and the name of my country, involved in such a crash. And I think it's high time, like I said.
Just, Martin, allow me to come in. And I completely agree that we've all had, it's a consumer business, so we all know people who've had lousy experiences over the last few years, right? International flights, seats are broken. I know friends who've flown, seats are broken, all kinds of issues. Even people flying, business or whatever, it shouldn't be that way for any class.
And something, it's been more for the last 5 years. After 2021, it's got accentuated to a point where, passengers can't bear it. I mean, let's face it. From,
but
to India in 2011,
Yes.
And we were not, we were angry with Air India for other reasons, right?
Yes.
Okay,
And you're absolutely right. We used to criticize the airline when it was, as you said.
Exactly.
Yeah.
It was never a product quality. We were angry for airlines for customer services, bad service, blah, blah, blah. But and the aircraft held together. It was a good aircraft. But today, Air India, the Air India that we see today is cosmetic. It's just branding.
But my question is this, Martin. Are you pointing to, these issues inside the aircraft? I mean, basically coming from lack of maintenance, upgrade or whatever. Are you linking that with the general attitude, which perhaps may have, caused in some lack of maintenance? Because is there a link between that and, of course, something like this happening?
You're spot on. You're spot on. I think that's exactly it. That's exactly it. And not just that, let's also link the whole objective of the management position on this whole airline. The first thing you do when you take over Air India is you should have cleaned the skeletons in the cupboard and sorted out the fundamentals and reinforced the basement and foundation. You can't just do a branding on the top and hope like hell that everything improves. It's never going to happen, guys. We've seen it with Tata Motors in the past. We've seen it with how many transformations in the past. Tata Steel. Air India is experts at doing this. They earned their PhD at business transformation. And to see Air India, it's been 4 years. To see the Tata Group and Singapore Airlines, mind you, fail at turning around Air India, 4 years. It says a lot, and this nonchalant attitude, you're right and you're spot on. You've said it the way it is. It's high time that changed now. And it's high time, somebody rolled up their sleeves, got down and dirty, fixed that airline ground up. Because, we cannot see any more of this. Air India is planning an IPO in 6 months, in about a year from now. So this messes the whole thing up.
Yeah, no, absolutely. Although I want to also point out that we don't know what caused the accident, but take your points on the quality and the customer service and the experience, etc. I completely take that point. But what I'm saying is we don't know whether we can link that to what caused the accident. I think we need to keep that in mind as well.
I agree. I think we should not speculate. Let a full-blown investigation come out.
Absolutely. Let's just get Kinjal in as well. Kinjal, thanks for waiting. Your first thoughts on what's happened and, how do you look at this from an aviation sector perspective now?
Obviously, this has been a very unfortunate incident, which no one would want to happen. We've seen certain such incidents happen in the past as well. But when I talk from the industry point of view at this point in time, obviously, such incidents do have some impact on the overall supply of aircraft that could come in the near term, because there would be certain checks at Boeing level and at the airline level that would keep on happening. And when we saw incidents with Boeing 737 MAX happening in the past, we did see that there were issues in terms of delays in delivery of aircraft, and the industry overall did face a supply issue. And this also comes at a time when the industry is anyways struggling with supply issues because of the aircraft on ground, because of the Pratt & Whitney engine issues. So roughly as on March 2025, we had around 16% of the fleet of the Indian aviation industry being grounded because of these P&W engine issues. Obviously, it's lower than the earlier numbers when the issues started cropping up. But the recovery or resolution is still happening. And we need to see that how supply gets impacted in the near term. Currently, in a scenario where the aviation industry demand is expected to continue to be very robust. So FY25, we ended with roughly 7.5 to 8% growth for the domestic aviation industry. And ICRA estimates that FY26 also would see a similar 7 to 10% YOY growth in domestic passenger traffic. So in such a scenario, the supply of aircraft is going to be very critical to help service the demand for airlines.
Kinjal, what does this mean for the other Indian airlines? Say in Interglobe Aviation, how does this fallout, this tragic incident, reshape the entire aviation sector in India? Can it hurt AI?
See, it's difficult to comment on airline specifics because, like I mentioned earlier, that we've seen these issues crop up in the past. Obviously, resolutions take time, and the industry takes time to come to the path of steady recovery. But despite these issues in the past, we've seen industry recover gradually, and that's what's going to be the expectation going forward as well. That there would be certain solutions which will come up, and we could probably get over these situations at the earliest.
Okay, all right. I think, it's a conversation we'll continue to have. But for now, we'll say thank you to both of you, Kinjal and Martin. Appreciate you coming on today to talk about this particular issue at this point in time, the accident which has happened. Hopefully, we'll get answers sooner rather than later in terms of what really went on. I just want to take a quick look at the market right now. 290, 300 points lower is what we have. So 24,600 at this stage. Najal, I think we have the next management with us.
That's right. Let's talk about City Union Bank. The board has approved a 500 crore fundraise via the QIP route. Let's talk about more of this and also how they see business for the remainder of this year. We're joined by Mr. Kamakodi, the Managing Director and CEO at City Union Bank. Hi, Mr. Kamakodi. Good morning. And good to have you on the show, sir. Give us a couple of details. This QIP, it's an enabling resolution. Could you tell us, why you looking to raise this money? And by when should we should see this money being raised?
It's only an enabling resolution, and we used to have this as the part of our annual shareholders meeting to get the shareholders approval and get that approval in place, if at all it is required. We don't have any immediate plans on hand to go for capital raising at this point of time. In fact, we have been having this as the part of shareholders approval for the past maybe about 14-15 years. And we used it only once, and we are having a Tier 1 capital adequacy ratio itself in the excess of 20%. So we use it if at all we get any, opportunity or the offer which we cannot refuse. So at that point of time, this will be in handy. So as per the regulations, if we get shareholders approval once for QIP, it is valid for 1 year. Okay. So every year we get this approval from the shareholders, and we use it only when it is absolutely necessary.
So as of now, it's just an enabling resolution. You may or may not raise this money, right?
Exactly.
Got it. All right. Let's talk about business then. How's business shaping up? I think you were guiding for around mid-teens loan growth, credit growth for this year. Do you stick to that? And now you've got a bit of a booster shot coming in with that CRR cut. How does it change things? Do you get a little bit more optimistic? And also in terms of NIMs, I think for the last year, you clocked around 3.5, 3.5, 3.6% or thereabouts. Given that you have a couple of repo rate cuts as well, how do you see this pan out in terms of the yields coming in a little bit lower? And in turn, what does it mean on the NIMs front?
See, actually, we are continuing with our past guidance of mid-teens, whatever we communicated to the market. We hope we'll be able to, achieve that figure, and probably, if possible, a percentage point more or from the points which we guided. We are trying to work on that, and it is going as per our expected planning. Because of the rate cut, as you know, when we get into the increasing interest rate scenarios, the asset gets repriced quickly. Liabilities take a little bit longer time, and you have expansionary margin. But at the same time, when you get into the decreasing interest rate scenario, some sort of the assets gets repriced quickly, and liabilities once again take a longer time. So there used to be a little bit contraction in the margin. But this time, we expect a similar behavior. But the good part is that since it has come in a single shot, even though there could be issues maybe for a quarter or so, year as a whole, we expect whatever net interest margin we achieved in the past and we guided, we hope we should be able to achieve those figures as we for the year as a whole, even though there could be 1 or 3 to 4 months of contraction. But since it has come in one shot, I hope we will be able to, year as a whole, we will be able to maintain whatever we have achieved in the past.
Just in the near term, sir, Q1, Q2, when there will be NIM compression, what could the NIMs drop to?
As we had already guided in our conference call after the, March quarter results, what we had about, 3.5 to 3.6 percentage in NIM. we should be able to have maybe about 10 plus or minus 10 basis point to start with. We are already taken certain steps, like for example, one of the major steps was that on a gold loan, which constitute about 25% of our book in the last year itself, we converted that as the fixed rate product and not a floating rate product. These things help us to moderate the shock, and also the deposit rates are also getting repriced quickly, which will help us to have like say having that passed on like say quickly. So we hope maybe about 5 to 10 basis point this way or that way.
Not significant. So then about gold loans, you said it's about 25% of your portfolio right now. Yes. What percentage of that would come in the small loans category, sub 2.5 lakh, for which the RBI has eased norms, where you can lend up to 85% of the value?
Almost 75% of our gold loan book are coming less than this, about 60 to 70% coming below this less than 2.5 lakhs bracket. But at the same time, we don't have any immediate plans to increase the LTV to 85% at this point of time, because like say there are multiple concerns are raised about how the gold price can move forward and all. We are continuing with our existing LTV. We will take appropriate call as the time progresses.
All right, Mr. Kamakodi, final question before we let you go. You've been talking about your unsecured book, growing that. But from an industry perspective, do you believe that the worst in terms of pain in that segment, is it behind? If you could give us your analysis on that, I think you want to grow to around 5% of your book. You could give us a number or there. And also, one point that the street always looks at with regard to your bank is, what is the targeted ROA? Could you tell us where do you see that number headed?
See, basically on the unsecured book, when we said 5%, it is on 3 to 5 years of, like say, time schedule. We are very slow and measured, in particularly when we are increasing our unsecured book. And whatever book we have built in the last year or so, like say, it's holding well, and we don't have any issues. And we are not rushing anything, particularly on the unsecured front. So we had, like say, achieved an ROA of 1.5% book, and we hope for the current year also we should be having our ROA in around the same range as we have already demonstrated, maybe plus or minus 5 to 10 basis points.
Okay. Thank you very much, sir, for joining in. Moving on now to the next topic of discussion. The Finance Ministry has clarified on reports about the possible introduction of a merchant discount rate, MDR as we call it, on UPI transactions, saying they have no plans to levy MDR charges. Paytm share prices took a big knock yesterday, the single biggest drop since February of 2024. On this clarification, strong clarification coming in, I think the stock price was down about 5 to 6% yesterday. Let's get that up once again, the Paytm share price. Pranav Gundapalle, the senior analyst India Financials at Bernstein, is with us, and in a bit, Abizar Divanji will also be joining in. Pranav, for now, it's a sentiment knock, but does this alter your earnings expectations for Paytm and even PhonePe? They're planning an IPO, perhaps, in the near future. Will this affect the prospects of PhonePe?
An MDR on UPI was never a base case scenario for us, and therefore was not modeled into our numbers, and therefore our numbers for Paytm doesn't change. And we've always held the view that MDR on UPI is a very low probability event, almost unlikely, not just because it's a populist move, but more because the ecosystem as a whole has seen significant benefits from the zero MDR and therefore the exponential growth in cashless payments. And it would not be wise to risk that growth in the pursuit of charging MDR, right? So I think as a system, the benefits are significant, be it in terms of reduced ATM transactions, increased credit opportunities for banks or payment players, or reduced printing costs for currency printing costs for the government. So the overall benefits are already significantly higher than whatever revenue could be earned through MDR. Therefore, we don't see a possibility of it coming through. And for Paytm specifically, I think they are close to break even. We expect them to break even next quarter. even without an MDR on UPI. So we don't think that changes our outlook on Paytm per se.
Gentlemen, morning, Pranav and Abizar. I think, so Pranav's point is clear. This MDR on UPI reintroduction was never in his base case. And the benefits of keeping it free far outweigh any collections, etc. Right? And in terms of collections, the Payment Council of India, etc., have said that government incentives are about 1,500, but the cost of maintaining UPI-related infrastructure is about 10,000 crores. So there is a big gap in that sense. Abizar, your thoughts on this issue? And was this a realistic assumption to begin with? I mean, is there a need to do this? Once this became free, UPI, of course, has become the payment of choice. If you reintroduce or bring forward a small charge, will it really hurt UPI and significantly dent UPI volumes? Your thoughts?
Oh, yes, it will dent UPI volumes, obviously. India is a price-sensitive country in that sense. But think about it, if you have such a large cost that you incur, and I know it's compared to currency cost, etc., it is much less. But the fact that you incur such a large cost would not make any long-term sustainability possible. So ideally, what needs to happen at some stage is that for above a particular threshold, maybe you can say 500 rupees or something like that, there needs to be some charge that could come in. So today, for example, people who pay hotel bills, or people, restaurant bills rather, or people who pay for certain utilities above a particular amount, or people who go to, supermarkets and purchase stuff off UPI. Those are the people who should be incurring some kind of cost. And I think I'm in favor of having some reimbursement or some MDR charge on it. What I'm not in favor of is, say, small street vendor type payments, people whom you've got into the banking system or into the formal system. Those kind of payments, I think, will become more sensitive to any payments. Take a threshold, I take 500, you could take 300. But whatever threshold one takes, I think there has to be some charge at some stage. Otherwise, sustainability is always a question.
Because the government provides whatever it provides through the budgetary support, right? I mean, obviously, it's not enough. It could provide more, perhaps, in that sense.
No, that's what, you can provide something through budgetary support, but budgetary support is not sustainable models. See, what you really want also is that while there is UPI and there is government-based UPI, there are other service provider models that are emerging. There are the likes of Paytm, as we have somebody on there. Or there are similar other models. And I think sustainability, investment in technology, avoiding of risks, investment in cybersecurity, etc., will require some level of business model to be in place. We are a Robin Hood country. So you have large transactions trying to subsidize smaller ones. That would make business models more sustainable.
Robin Hood country. Point taken. Pranav, just reflect on some of what Abizar said. From a regulatory, long-term sustainability point of view, what's your sense?
Yeah, I think there are two parts to this. One is the regulation part, and second is the competitive intensity part. So even if, let's say, RBI and NPC and government agree and bring in an MDR, our view is it will go down the route of the IMPS transactions or the NEFT transactions, where in theory, there's a charge which could be applied for transactions, but for all practical purposes, most banks have waived it off. Because today, let's say MDR is allowed. There is a long list of banks who really want to get back into the payment space, which they realize they have ceded to the fintech platforms and would be happy to subsidize zero-cost payments. So one is the regulation part itself. Second is the competitive intensity, where we've seen that these are completely replaceable products. I mean, if we saw that when regulatory actions hit Paytm, customers moved almost instantly to other platforms. So there's no switching cost involved. And therefore, the ability to charge would be quite minimal. The way it is visible is if you look at some of the other internet platforms, take your food delivery or e-commerce, they've already started flexing their pricing power by introduction of platform fees, search fees, and whatnot. We don't see that really playing out in the payment space, which tells you of the pricing power that these platforms have, which is pretty much non-existent. So online transactions, maybe yes, because you don't have the cheap option of cash or zero-cost option of cash. Maybe there's some pricing power there. But for offline transactions, we expect it to remain near zero. And this is the same we have seen in other markets. Like if you take China, for example, where it was a duopoly, there was no restriction on charging MDR, but still the offline transaction costs or MDRs were nearly zero. So the chances of any big revenue upside, while on paper it looks massive, right? I mean, if you charge a few 2-3 basis points on the volume of transactions, it'll have significant impact on EBITDA for Paytm or PhonePe, any of these businesses. But the probability of that playing out seems to be extremely low at this point.
No, absolutely, got that. Pranav, when you began by saying the cost, the benefits outweigh cost. Have you done any analysis? And you said there'll be some cost is put on, banks will waive it off. There's enough banks wanting to gain back market share, which is seeded. Have you done any work in terms of what this some of the biggest players are able to do by offering this free of cost and make up in terms of revenue otherwise in other segments, lending, etc.?
Yes. So we have done the analysis. So for example, let's take banks, the different stakeholders. The cost savings for banks in terms of reduced ATM transactions, the ATM transactions have come off by 30-40% from the peak, pre-COVID peak. And the cost saved there would almost be equivalent of earning about 10 to 12 basis points on the UPI transactions. So that's the amount of cost savings that they would have enjoyed. So they wouldn't want to risk it. Similarly, for the government, simply the reduced printing cost would be equivalent of 2 to 3 basis points of UPI transactions, merchant transactions, and that's close to what they are actually paying out as a subsidy. The other revenue addition that banks have got is simply the ability to lend. So if you look at the business banking growth that many of the banks are seeing, some of that or a large part of that is being enabled by the transaction history that is now being generated, which allows them to underwrite those customers. Lastly, the payment platforms itself. Now, while yes, there is a cost involved in providing the payment infrastructure, the fact that a Paytm is able to break even today tells you that there are other ways of monetizing, be it in terms of providing loans to merchants, the sound boxes where they earn a revenue. So people have figured out other monetization avenues, and that seems to be enough to break even. Now, you need to therefore look at it as a whole and not as a single service that's being provided. It's the same as ATM transactions. ATM transactions are free in the country, at least for 5-6 transactions. There is definitely a cost involved, significant cost involved, but nobody gets charged because the bank earns money in a different place. They get cheap savings accounts, which is the revenue source. So we need to look at it at a holistic level and not just based on the payment transactions. And if there is one particular entity that's incurring more cost, then I think it boils down to their negotiating power in the ecosystem and therefore the ability to charge and earn a revenue.
Well put. Abhi sir, while you are advocating for perhaps some sort of a tiered structure, high value transactions are charged, there is a commission on that, but there is a competitive angle that Pranav was talking about. And also UPI has been such a phenomenal success story. Like, I mean, it's something that the government is also very proud about. So will there not be that populist pushback that if they go ahead and introduce this, regulatory charge?
Certainly there will be a pushback. There's no doubt about it. But what part of the segment are you charging? If you charge a fruit vendor, of course there'll be a pushback. And I'm not asking that there should be a charge on a fruit vendor. What I'm saying is that UPI today is benchmarked with a free service. And that is why that service is not valued in the ecosystem. So for example, take a Swiggy. A Swiggy knows that if I am ordering some food worth 5,000 rupees on Swiggy, the UPI transaction is free any which way. But if there was a charge mechanism that UPI did, there would be competitive forces coming in who may provide better payment services. And even if UPI charges some charge to it, that is a benchmark cost allocation that Swiggy will have to do to that payment provider. So I think that ultimately a service, if it is classified as free, will never get valued. But if a service is put some value to, then for larger transactions, it will do. What UPI has achieved and phenomenally achieved, 16 billion transactions last month, February 2025 actually. But if you look at it, it is a phenomenal way of shifting people to the formal system. I think the government has done their job. What had to be done is done now. We are so used to Swiggy. It's like Reliance Jio trying to offer you initially internet free. I know in my area, internet was free for the first few months, and now I can't live without it, and I pay whatever they charge me for it. So as a premium user, I think this country, as I said, is about inequality. It's a Robin Hood country. So at the end of the day, the people who are privileged enough should be paying for this service. The service will only mature. The government subsidy can then be diverted to slightly better people, and alternatives to UPI will come in, which will get UPI to upgrade its own technology. So there is nothing wrong in having a revenue model which enables people to provide better service levels through investments in technology, investments in risk. Think about the issues that may happen if these payments are incorrectly done and the technology is ignored. So I just think that while there are other ways of making money and people will figure out ways of making money, and banks may say, I will absorb the cost, but let there be a cost.
Let there be a cost. Got that. Thank you, gentlemen, for that. So two sides of the story, but there is that convenience, efficiency, speed angle, and perhaps there should be a charge for that. Thank you very much for joining in. Here's what we will do. We will slip into a very short break. We'll come back and talk commodities on the other side. Don't go anywhere. Well, it's all happening in the commodity markets. Manisha is now joining in to put the spotlight on the crude market.
Thank you for that. Well, yes, you woke up with a very strong gain coming in for the crude oil prices. Until last evening, we were down by 2%, by the way, in the New York session. It all started happening in early Asia markets that you saw the crude oil prices open up at 5% to 6%, went all the way up to 12% as well, and it's trading 10% on the higher side right now. If you look at the prices, then we are up by 17% in this week, and this is the best weekly gain that the crude oil prices have seen since the year of 2022 there. And if you look at the last 1 month, we've turned positive here as well, up 20% now. And in this year as well, we've turned in the positive. Until last week, we were down by nearly 7% for the crude oil prices. But as you can see on your screens, with the kind of gains that we have seen coming down today, we are up by nearly 6% for the year right now. And when you look at the previous last 2 years, well, of course, the crude oil prices are still trading into the negative there. But this year has seen positive. The cues clearly coming in early morning after Israel conducted a preemptive strike on Iran. And the various statements that have been coming in from Israel as well are keeping the crude oil prices up at 10% in the Asian markets right now. The attack does set off a new conflict in West Asia, and there are now fears of regional war as well coming in, supporting the prices. Well, Israel has declared a state of emergency as it braces for retaliation from Iran. Iran, remember, has been issuing statements saying that it can retaliate not just on Israel and other countries, but especially on U.S. bases as well. Iran has threatened to target U.S. bases if nuclear talks fail. We also have seen reports that Iran could soon retaliate against Israeli targets, including civilian areas as well. So this whole Middle East tensions is what has led to the crude oil prices boiling, as it were. The prospects of broader conflict in West Asia and the fact that it could lead to supply disruptions going forward as well is what is leading the prices where they are. Strait of Hormuz is an important vital route, remember, and nearly 20% of global oil flows through here. Red Sea concerns are still ongoing. We've seen those container freight issues continue into the market, and this could be an added one. The U.S. personnel, in the meanwhile, have continued to move out of the region with ongoing threats. This has been happening for the last 2 or 3 days now, ahead of these attacks and the kind of statements that we saw from Iran coming in as well. Interestingly, importantly, Trump also yesterday said that he expressed actually frustration that oil prices had risen amid supply concerns within the Middle East, and that he doesn't see oil prices moving beyond 70 or 75, but we are trading at around $76 a barrel at this point in time. It's not just about crude. When you look at the crude derivatives like natural gas, heating oil, gasoline, those prices are trading above nearly 4% right now. We're trading at multi-week and multi-month highs for many of these commodities at this point in time. So when you look at the prices itself, well, last month was a good one. We saw 11% of gains coming in for the month of April, and May was up 11%, and June is up 18% at this point in time. And if you look at the crude oil prices on an year-on-year basis, the last couple of years were in the negative. We saw 10% of decline in 23, down 3% for 24, but we are up by 5% in this year now. Last week, it was down by 6%. We're trading 5% on the higher side right now. So that 11% of a move clearly comes in the overnight markets.
Thank you very much for that. Get into a break. On the other side is our special segment. It's the Economy. Lata speaks to Hitendra Dave, head of HSBC South Asia, on tariffs, geopoliticals, and the India growth story.
Welcome to It's the Economy. Financial markets have been in a state of churn for the past 6 months, and the Israeli attack on Iran has taken the uncertainty and the worries just one notch higher. Can this war, if it continues, push up crude prices and disrupt growth even further? And will India continue to be somewhat resilient to the turmoil, given the domestic drivers for our economy? I have with me a seasoned watcher of the Indian markets, watched it perhaps from the Gulf War itself, 1990. Hitendra Dave, CEO, HSBC India. Hitendra, you were there in 1990 in the markets?
No, not so. Not as old as I look.
No. But still, if you can give some perspective to how we should look at this, should it be looked at as prolonged, or the previous Iranian last October was a brief one?
Well, clearly, I possess no expertise in understanding geopolitics and how long this will go on. But perhaps if you see how this transmits into India and to wider, broader financial markets, one is always through the sentiment channel, right? Historically, people have associated high oil prices as being negative for India because India imports 80-90% of its crude oil. It's also associated with broader financial market uncertainty. If in a broader financial market uncertainty period, emerging market currencies, emerging market equities, they tend to be less attractive as such. But if you go a little deeper, if you set aside the sentiment and set aside people have to react when they get up in the morning to crude at 75 or whatever. See, oil demand in India has been growing at about 3.5% for the last 10 years plus. Economy has been growing at between 6.5% to 7.5%. So therefore, the oil intensity of GDP actually is coming down quite a bit. So its impact, higher oil prices in 2015 was very different to what it should be in 2025, and hopefully in 2035 it will be even less minimal. But sentiment has a very important role in financial markets. So if this particular situation that we have is long-lived, then obviously we will be. But overall, as you mentioned yourself, we don't get into the oil's contribution to CPI is low, etc. So I would think this should blow over quickly from a financial market perspective.
Yeah. No. Oil contribution to CPI will not be an issue because the government did not reduce prices for the CPI basket even when prices fell to $60. So we don't have to adjust it higher for now. But, the inflation number came in a little lower than even low expectations, 2.8. And chances are that it could be 2.5 for the month of June because edible oil tariffs have been cut. So, there were expectations in the market after the last policy that the terminal rate will not be 5.5, but could go. Does that hope still remain?
See, I would put it like this. With the Reserve Bank having changed the stance to neutral, I think the bar for any further rate actions, either direction, is very, very high right now. It does look like if it had to move, it would move more lower than higher because neutral, as you can go either way. But the economic data that we are presented with, growth at around 6.4, 6.5, which is very good when you compare it to the rest of the world, but relatively disappointing relative to our aspirations as an economy and as a country. Inflation, as you mentioned, I think it's likely to undershoot RBI projections. But for RBI to take any further rate action, I think the bar is quite high. So it has to undershoot quite dramatically. It cannot undershoot by just 30, 40 basis points and RBI changes. So you will need to get month on month successive prints that force the MPC to think that this neutral, which gives them flexibility, they could use the flexibility. But as I said, the average for the year would need to be, let's say, 2.75 or something. And not just for the current spot prints or inflation prints, but also what you're projecting 12 months hence. You need to get to a point where the 12-month hence inflation projection at 5.5% policy rate makes the real rate look very high. That's what you need to get to.
Okay, no, that's not there. At the moment, a dipstick I did indicates that next month will be, or rather the June print, this print will be 2.5%, or some people are even putting it lower. So we undershoot the Reserve Bank's 2.9 forecast for the quarter, but not by much. It would be maybe by 20%.
I think the key is 12 months hence.
Yeah. And actually the governor made that very clear, and that's why he was moving to neutral. Okay, I'll come back to the growth in a bit. what have you made of this CRR cut? This is outside the RBI's DNA. We have seen them use CRR only incrementally. 1%, what is the message?
I think 2-3 messages here. I think one is the industry has always questioned this, right? I mean, you take 4% of my deposits on which I pay interest and I earn nothing at all. So to that extent, you can look at it as finally Reserve Bank of India has accepted the industry's demand a little bit. I think the second thing is, and we have seen in the last 5-6 months, I think there is a very strong belief in the MPC/RBI that rate cuts without liquidity don't really have the same, the same effect as the desired effect. So I think this is really reassuring deposit-taking teams, lending teams, as much as money market dealers and bond traders, etc., that don't worry, liquidity will be there, it will be abundant, we will always be soaking in liquidity for the foreseeable future. You now plan your deposit and lending activities and rates accordingly. So I would think this is largely about ensuring that there is a long-term commitment on the part of RBI so that the transmission, which is in early stages, doesn't fall off, especially if RBI is not able to, the dollar positions they have in the period in which CRR.
The tussle is when you say neutral, the yields actually went up. On the policy day, in spite of this massive double bazooka, yields went up from 6.2 to 6.3 almost, the 10-year. So in spite of it, you think transmission will happen because of the liquidity?
I think there are two markets. One is the bond market. And then is the much larger loan and deposit market. I think loan and deposit market will react. It always reacts slowly. See, it is by nature, it doesn't react to a rate cut and straight away start affecting, unlike T-bill markets or bond markets or whatever. So there, I think as long as you keep liquidity abundant and you have the assurance of liquidity will be abundant even during the busy season and all that, I think you will find progressively lending rates come down, deposit rates come down. In any case, we are living in an era where a very large part of the bank loan market, bank assets are linked either to repo rate or to T-bills, right? So there the transmission has been quite remarkable.
Yes.
I mean,
Yes.
100 basis points just in 6 months or so. And in the case of T-bills, even more than 100 basis points or so. So to the extent these rate cuts and liquidity injections were towards transmission, that I think will continue to happen. And each month it will continue to happen. On your point on why is the bond market not getting the message from RBI, they've got 50 basis points, which was more than almost everyone's expectation. They've got a CRR cut, which wasn't on anyone's agenda or radar at all. I think you just need, for some time, things to stabilize. I think this uncertainty and today, the opening question that you had on oil and Iran and Israel, I think doesn't really help. But my sense is, I think, as with the passage of some time, I think as RBI is able to clarify what exactly do they mean, what exactly should the market be projecting in terms of what happens if inflation undershoots and things of that nature. I think the market will really, I think it's trying to discover equilibrium today. Okay. So any help anybody can offer in helping discover that equilibrium will help.
Okay. What's your sense about FII and FDI, more particularly FPI in bonds? Do you think this gets disturbed? We saw good flow and then it tapered for a month, I think.
No, see, I think if you're an FPI sitting in New York, London, Geneva, wherever in the world, I think the one common word everybody uses, I mean, you read MPC reports of many, many central banks, the most commonly used word is uncertainty.
Oh, that's true.
Okay, and if you're sitting so far away from a country and there is so much uncertainty, tariff was one, oil is one, geopolitics is another one, do you want to keep cash close to your chest? It's a natural reaction. I think many Indians are doing the same. So why would foreigners not behave differently? So I think as far as bond market is concerned, the key drivers, which is lower rates, abundant liquidity, frankly, zero supply, right? We are into the third month of the financial year. I think net of RBI OMOs and government buybacks and things like that, there is zero supply. So the underlying conditions of fixed income markets are very, very constructive as they've been in many, many years. I think you have to ignore what's happened in the last 3-4 days because the market will find a new equilibrium, the positions will get washed away, etc. And then you will see the next round lower is my sense.
Just give me a final word on what you make of the India story. You stand on the crossroads of FDI as well. Does it look like we will attract China plus one? Does it look like private capex will pick up?
See, China plus one, there is a logical reason for India to aspire to be the largest country that gets the supply chains and manufacturing located inside our country. The government has tried out quite a bit, right, through production-linked incentives and capital subsidies. So in certain sectors, you can see success. You can see it in phones, you can see it in semiconductors, you can see it even in some electronic products as well. At a broader level, I think people who are closer to this subject than I am do tell that the opportunity is there. Okay. But there is no God-given right we have that it will only come to us, because countries smaller than ours have ensured that the whole ecosystem, from land to people to electricity prices to logistics, yes, port transportation, TATs at the ports, etc., everything has come together. We should not be wasting this opportunity. This whole development around US tariffs is I think every board around the world must be thinking which country should we go double down on, and we must do everything possible. I know the government, you can see lots of ministers traveling around the world, etc., but this is really for us to lose.
Okay. Let's see. We'll do our best. Thank you very much, Hitendra, and particularly for dropping into the studios.
My pleasure.
And this interesting conversation. We have to wind up on Bazaar. Chartbusters up.